We just finished going through LPKF's Q1 FY2026 earnings call materials, and now we want to share our takeaways with you. Look, revenue down 32%, adjusted EBIT down 68%, and the solar division off a cliff at minus 80%. Most folks see numbers like that and run for the door, plain and simple. But the stock didn't fall apart, it actually held up, and that's the puzzle. Something is happening underneath this ugly fiscal year, and that's what we want to unpack. Stick with us, we'll walk it page by page and show you if this is real or just another dream. Let me start with how ugly this quarter looked, because it looked rough. The filing shows revenue down 32% year over year, adjusted EBIT down 68%, and the solar division collapsing 88%. That solar number is the anchor dragging the whole P&L into the red, no way around it. Most retail investors closed the tab right here, and honestly, I get it. But pay attention, the company stated this is according to plan. They are deliberately absorbing the solar collapse to fund the future. Here's the other side. The company stated over 80% of potential clients are validating the tech, and it calls its advanced glass packaging positioning completed. So you've got one hand of garbage and one hand of aces, and that mix is exactly what makes this name interesting. Our take is simple. This quarter's loss is not the point at all. The valuation hinges on one question: can that 80% positioning convert into real mass production orders? Convert it, and the story is real. So what does this company actually sell? Let me keep it plain, it doesn't make AI chips, it makes the tool one layer upstream of the chip. AI chips now want glass as a substrate, but glass is hard and brittle. Drill it the old way and it cracks on you. LPKF uses a laser to punch ultra-fine holes in that glass, a process called LIDE, basically a scalpel made of light. Everybody's rushing to mine the AI gold, and this company isn't mining, it's selling the shovel to every single digger. That neutral seat, is it a bad place to be? I don't think so. The company stated AI and HPC wafer starts are surging, and that translates almost linearly into equipment demand. Now radar has to tap the brakes. That word linearly is the company's optimistic framing, and it still needs orders to prove it. But our take is, this is exactly the moment LPKF bolts itself onto the AI trend as an upstream beneficiary. Why does it have to be glass? This one comes down to physics, plain and simple. AI chips keep getting bigger and denser, and traditional packaging hits a wall in 3 spots. Heat can't escape, the signals start distorting, and the whole board warps under the load. Glass substrate with through. Glass vias handles all 3. The heat clears and the signal stays clean. So nobody fell in love with glass, the physics forced the industry down this road. The company stated the shift is concrete, rivals are breaking ground on factories, and the addressable market is being revised upward. That tells you customers are spending real money, not just talking, and that matters. But radar's going to pull you back to earth for a second. By industry logic, glass is still early, single-digit % penetration today. Direction established is not adoption completed, and the slope of that adoption curve is the single biggest variable for how much LPKF actually earns. Here's a question that should bug you. How does a small German shop force its way into the semiconductor chain? That bar is sky high, so what keeps them there? Once they're in, the company points to 2 moats, and the first one is time. The filing shows dozens of LPKF machines already running live at client sites for years. A head start measured in years is not something a rival closes overnight. The second moat is sharper, it's the IP. The company stated its IP is visibly identifiable in the final product, which lets it enforce patents fast. On the map, Korean and German rivals are circling, but the German peer respects the IP and just lacks field maturity. On the Chinese manufacturers, the company's stated IP respect is highly questionable, and it's already initiating legal action. Our take is, visible probable IP is the ultimate shield for a supplier this small. But hear me clearly, the moat stops you from being replaced. It cannot speed up when customers actually adopt. LPKF got in the door with one tool, but the ambition runs way past that. The company stated it's rolling out a platform called Nexa, stacking several process steps onto one chain. Layer 1 is LIDE, the structuring step, the foundational entry ticket that got them inside. Layer 2 is tensor ablation, cutting the ABF layer, and the company estimates that's a €100 million market. Pay attention that 100 million is expressly layered on top of LIDE revenue, not inside it. Layer 3 is tensor bonding, glass stack bonding, though the company is withholding that market size for now. Why build all this? Because the customers literally asked for it. The company relayed the client's words, "You're already in our chain. What else can you do? We don't want just a single process step." The customer is holding the door open and begging you to sell more. That's rare air. Our take is, Platformization turns the depth of a client relationship into the breadth of total revenue. This quarter's financials have two faces, pulling hard in opposite directions. The ugly face first, the filing shows revenue down 32% year-over-year and €8 million drop, and operating cash flow off 73%. That's blood on the floor, no sugarcoating it. Now turn your head. The other face is a completely different animal. The company stated order intake rose 18%, the book-to-bill ran above 1.4, and contract liabilities jumped 66%. Book-to-bill above 1.4 means orders pouring in faster than they can ship. That's demand backfilling. Here's the line that ties it together. The company stated revenue fell €8 million, but EBIT only fell about €2 million. That gap tells you the North Star cost cuts are actively absorbing the revenue shock. So the past is collapsing while the future is quietly backfilling. Both true at once. Our take is, with this kind of report, you watch one thing: when the falling line and the rising line cross that inflection, and this name turns. The company runs 4 segments, so let me crack each one open for you. Start with the worst, solar. The filing shows revenue down 88%, just €1.3 million for the whole quarter. It bled an EBIT loss of €1.6 million, and the company stated it only contained that through short-time work. That engine has basically stalled out. Electronics held the line, revenue flat, but adjusted EBIT down to just €400,000, off 70%. The company stated that's the price of preserving its core technology lead, spending to stay ahead. Now the bright side. Development grew revenue 9% with strong profit growth, the standout this quarter. Welding's the surprise, revenue ripped 21%, driven entirely by a single smart robotics bulk order. Profit there stayed flat. The company stated that's down to the capacity investments it had to make. The old engine, solar, is cutting out while development and welding are firing up. Our take is this is a company swapping its engines mid-flight, old ones sputtering, new ones lighting. A good story means nothing if the company can't survive long enough to tell it. That's where North Star comes in, their cost program, and the first piece is consolidation. The company stated it closed the Fiscal plant, cleared the personnel, and merged operations into 3 sites in Seoul. Headcount is down 5% year-over-year, so this is real cutting, not for show. Then there's the lifeline, and this one matters most. The company stated it signed a new financing agreement with its banking syndicate in Q1. Funding for restructuring and R&D is strictly secured through 2028, so the tank won't run dry mid-journey. On the target, the company stated management is aiming for sustainable double-digit EBIT margins by 2028. Let me flag that double-digit by 2028 is a stated goal, not a done deal, so hold it as a target. Our take is, this cost-cutting isn't about saving pennies, it's about building the resilience to outlast the wait. LPKF needs the breath to survive the gap until the AI packaging timeline finally matures. This is the heart of the whole thesis, so do not tune out here. The company lays advanced packaging out as a funnel, 4 stages, left to right. Stage 1 validation. The company stated over 80% of potential clients are validating its tech right now. Stage 2 is where we sit today. The company stated 4 to 5 players are ready, and it took exactly 1 order from Korea in Q1. But pay close attention, the company stated that is a capacity order, not a true mass production ramp-up. Stage 3 is the real ramp. The expected scale is several tools per client. Stage 4 is high volume, scale of 50 to 100 tools per client. Do the math, going from several tools to 100 tools, that leap is enormous. Our take is that jump from several to 100 is the entire investment thesis. But here's the cold truth. The only thing cashed so far is that 1 small capacity order. The true ramp up, or the one that matters, is still entirely pending, still just talk. Now let me lay the whole timeline out, because timing is the entire game here. The company stated 2026 is the positioning phase, and management assesses that as completed. Then 2027 through 2028 is the ramp up, with AI scaling and tensor ablation going active. The company stated tensor bonding slips about a year, real sales now targeted for 2027, and CPO just entering positioning. The big volume lands in 2029 through 2030, high volume mass production with CPO scaling on top. The company stated those volume PLs typically arrive 6 to 9 months before production starts. Now here's the part that should make you sit up straight. The company stated its 2026 guidance is completely unchanged and strictly excludes any advanced packaging mass production orders. Chew on that. The biggest catalyst in the story isn't even baked into the numbers they gave you. Our take is management is treating advanced packaging purely as an upside surprise to manage downside risk. Even the company won't bank that revenue until the orders are real. That's telling. This is the page where Radar drops his voice, because this is the biggest worry in the whole name. Think of a packaging line as a chain only as strong as its weakest link. The two links LPKF owns, structuring and ablation. The company's stated yields are excellent, risk-free, proven by internal data. No problem there, that part's locked. The trouble is the other links. The company's stated steps outside its control still haven't hit customer yield targets. And the company's stated clients will only expand at a moderate pace while they troubleshoot. How long does that take? The company stated roughly a year for clients to scale from initial ramp to target yield. 1 weak link and the whole line can't go to volume, simple as that. Our take is LPKF's Moat stops a rival from stealing the contract, no question. But it can ask the customer to fix their own yield any faster. And that means the timing, the most important thing, is unhedgeable out of LPKF's hands. Here's a fair question with all these customers. What if LPKF bets on the wrong horse? Here's the thing, it doesn't bet at all. The company stated it serves everyone, focused purely on total addressable market and share, not picking winners. The company stated it's working with a double-digit base of customers, all actively validating right now. But it knows that crowd won't all reach the finish line. The company stated there's an attrition zone, players exiting on late entry or failing yields. And the company stated only 5 to 6 players will ultimately survive to carve up the whole market. So the players serve everyone. Don't pick a winner, just own a slice of the total pie. That's the neutral arms dealer, both armies fighting, and you sell bullets to all of them. But Radar will remind you, customer enthusiasm does not equal order certainty. Our take is, staying the neutral dealer is the only mathematically safe hedge against any single client failing. Time to flip on the risk radar, because Radar doesn't just sell you the bull case. First light the order vacuum. The company promised a true ramp, up PO this year, but so far only one capacity order has shown up. Words on the call, nothing real in the order book yet. Second light, the solar bleed. The filing shows that division losing around 10 million euros a quarter. The company flat out admitted it can sustain that for 1 year, not 2. Perovskite is bottlenecked by stability, and the company stated equipment sales are paused until 2027. Third light, selective silence. The company quoted a 0.5 billion euro TAM for LIDE and 100 million for ablation, but it refused to quantify bonding or CPO, so visibility there is low, and that's a tell. Fourth light, macro and IP. The company named around geopolitical risk plus active litigation against Chinese manufacturers. And watch this, backlog is down 26% year over year while inventory is up 18%. Our take is that inventory needs to deplete in Q2, or it turns from a setup into a problem. Let me pull this together with one frame that makes it click. Don't value this like a normal stock on earnings, value it like a call option. Our take is LPKF is basically trading as a call option on the AI glass packaging market. That ugly 2026 loss is the time premium you pay to hold the option. It's supposed to sting. The strike, the ignition point, is 2027 when the real ramp-up orders are supposed to land. Light that fuse, and the adoption curve scales hard into 2029, with the upside wide open. What about the downside? Is the option protected? It is. The company stated financing is secured to 2028, keeping the option from expiring before the market matures. And the strategy disperses downstream risk, hedging against any single client blowing up. So the real question isn't this quarter's EPS at all. It's whether you believe that glass adoption curve ignites in 2027 and scales in 2029. Believe it, and the current P&L is just the cost of admission. Last stop, here are 5 rulers to measure this story quarter by quarter. Ruler 1, the ramp up PO. Did LPKF land its first true volume order in 2026? Next catalyst for that is the Q2 earnings on July 23, market down. Ruler 2, order momentum. Can it hold book to bill above 1.4 and reverse that 26% backlog decline? Ruler 3, the cash flow. Does solar equipment sales resume by 2027? That one directly tests the company's own can absorb for 1 year promise. Ruler 4, operational execution. Is North Star keeping the glide path toward double-digit EBIT margins by 2028? Ruler 5, platform breadth. Does the ablation PO land this year? And does management finally put a number on tensor bonding, or keep dodging it? Our take is, until these 5 land, this turnaround is a theory, nothing more. When they hit, the ticket is cashed, and that's when you'll know the story was real. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar. Hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.